Over the last 80 years, the value of the American dollar, the standard, the trustworthy, safe currency, has eroded by 97%. And it's not this number that should terrify you. It's something else. So I'd like to welcome you all to the horrifying financial reality that is the 21st century economy, where we have successfully managed to build a world that functions exactly like a slot machine designed by a sociopath. You may look around and notice two things. First is that your weekly grocery bill now requires a second mortgage, and second, that every day some financial headline shrieks that the S&P 500 has hit yet another all-time high, proving mathematically that the very richest among us have found the financial equivalent of a glitch in the simulation. And the paradox is that these two things are not separate events. They are two sides of the same rapidly depreciating coin. Now, the erosion of the US dollar isn't some sort of natural decline. It's more of a targeted surgical strike executed by the very people that is sworn to protect it. Now, to understand how the value of the dollar is weaponized to inflate the value of your stock portfolio, you first have to understand where all of this new money goes. You see, when the Federal Reserve and the Treasury need to stimulate the economy, which is a nice polite word for pumping ungodly amounts of synthetic liquidity into the financial system, they don't airdrop cash onto Main Street. They buy financial assets, primarily bonds. This is called quantitative easing, or QE. So QE is basically the Fed standing at the edge of Wall Street with a fire hose full of newly printed digital cash, aiming it directly at the banks and institutional investors. So from the start of 2020 through early 2022, the M2 money supply, a measure of currency and deposits, ballooned from around $15 trillion to $21 trillion. That is a 40% increase in the amount of money sloshing around, and it happened in the time that it takes to binge watch 3 seasons of a mediocre streaming show. I'm looking at you, Love is Blind. Now think of what money is. It's a claim on a limited set of goods and services. When you increase the number of claims by 40% overnight, what do you think happens to the price of everything those claims are chasing? Rockets. Except here's the crucial point. The money doesn't go towards buying more artisanal sourdough bread or funding local daycare centers. It stays concentrated in the financial ecosystem, immediately seeking out scarce, desirable assets that are not easily reproduced. Stocks, bonds, commodities, and, most cruelly, housing. Now, the second mechanism that turns dollar erosion into asset inflation is the perverse incentive created by near 0% interest rates. For years, the interest rate on savings accounts or safe government bonds was so low it essentially rounded down to the annual rate of forgetting what you were doing. Now, this creates what Wall Street analysts call the TINA environment. Stands for there is no alternative. If you are a pension fund, an endowment, or even moderately successful investor, and your mandated goal is to achieve, let's say, 7% annual return, where do you put your money when the safest US Treasury bonds are yielding less than the cost of a fancy cup of coffee? Well, you can't leave it in cash because you know full well the central bank is actively trying to melt the value of those dollars, so the only remaining option is to plunge headfirst into equities, stocks. So the forced migration of capital, of money into the stock market is a key driver of asset inflation. It's not necessarily that the company is suddenly 40% more efficient or 40% more valuable, it's that the dollar itself is 40% less attractive compared to an ownership stake in something that is real. The result is pure, unadulterated stock market inflation. For example, the S&P 500's price-to-earnings ratio consistently inflated far beyond historical norms in the years following massive liquidity injections, reaching levels that financial historian Jeremy Grantham once described as fully fledged epic bubbles. We are forced to value companies at ridiculous multiples these days, not because they are innovating for the future, but because they are the least radioactive place to store your rapidly decaying dollars. Now, there is a third mechanism here, and that is the currency translation boost. So that's a phenomenon that is so clean and effective, it should be sponsored by Tide Pods. Now, this is where the dollar erosion actively pumps up the reported profits of US multinational corporations. So, imagine a giant US company, and let's call them Global Soda Corp, so we don't get sued, which sells a staggering 70% of its fizzy, caramel-colored sugar water in markets outside the United States. They sell a pallet of soda in the Eurozone, and they bank those profits in euros. Now, if the US dollar weakens by, let's say, 10% against the euro, when Global Soda Corp converts those euros back to dollars for their quarterly profit earnings or their quarterly earnings reports, they suddenly have 10% more dollars than they did just a few months before. Now, technically, the company didn't sell any more cans of soda or didn't really make any more organic growth. The European consumer didn't pay any more for their product. The profit margin simply materialized out of the magic of the currency depreciation. It's a literal foreign currency bonus that goes straight to the bottom line, inflating the reported earnings per share, or the EPS, which investors then use to justify a higher stock price. So this whole process creates this positive feedback loop. The weaker the dollar, the better the earnings look for the giants at the S&P 500, and the more money that they look like they earn, the more their stock goes up. It's an amazing trick. The policy that makes your imported groceries more expensive simultaneously makes the stock price of the company that imports them look a lot better. Now, however, out of all of the assets that get inflated from this mechanism, the one that is arguably the most harmful to Americans is when the assets in housing inflate. So during the COVID-19 pandemic and the ensuing low-rate environment, the Case-Shiller National Home Price Index showed home values soaring by more than 40% nationwide in just 2 years. Now, what happened to the median American income over that period? What happened? Well, it certainly didn't go up by 40%. Well, that is unless you were selling a lot of hand sanitizer at the time. But the reason for this chasm is simple. When the dollar is eroded, wealthy investors and institutional landlords and even single-family rental operators view housing not as a social necessity, but as the ultimate inflation hedge. They flood the market buying up homes with cheap, abundant dollars, driving out first-time home buyers and transforming the entire concept of shelter from a human right into an increasingly unobtainable financial instrument. So now, a lot of this just sounds dystopian and bad. So that brings up the question, why is this happening? Why are governments doing this? Now, the primary, most urgent reason the government finds a little inflation so incredibly sexy is that its relationship with its national debt is a little bit uncomfortable, to say the very least. Now, if you've seen my channel, you know I've ranted about this a ton, so I'll try to make this quick. Now, right now, the US debt is somewhere at around $37 trillion, but by the time this video comes out, it could be substantially more. Servicing this debt is crippling. But thanks to the magic of inflation, its real value can be systemically shrunk. So think of it this way. If the government borrows $100 today, and over the next 10 years, inflation averages 3% per year, the purchasing power of that $100 when it's finally paid back is actually significantly less. So, on the face value, it's all the same, but the burden measured in actual goods and services has evaporated. Essentially, the government is playing financial alchemy. Pretty much when the government can't pay back its debt, it causes inflation for the average person. And this strategy is not new. I mean, it's practically a dusty playbook from the attic of history. Following World War II, the US debt to GDP ratio hit a staggering 119% in 1946. The US didn't pay that off with responsible austerity or massive tax hikes. That would have been deeply unpopular, which is a political kryptonite. So, they managed it through a combination of sustained economic growth and, crucially, a decade of controlled inflation. Essentially, inflation served as an invisible knife quietly slicing away at the real value of that debt that they used to fund World War II until they reached a point where that debt was manageable in the mid-1950s. And the government is doing that exact same thing now, but they've cranked the dial up to 11. They are essentially telling bondholders, who are often other nations, large retirement funds, and yes, the Federal Reserve itself, that they will be paid back, but with currency that is slightly more like monopoly money every single time. It is a slow motion default by devaluation. a stealthy mechanism that avoids the messy public argument over who gets taxed or what programs get cut. But next, we're going to move on to another important point here, which is something called the wealth effect. So the theory, championed by generations of Federal Reserve economists, is beautifully simple and utterly elitist. If you inflate the stock portfolios and home values of the people that own those things, which is right now roughly the top 10% own almost all of those, then they will feel rich, and when rich people feel rich, they spend money. This spending should, prepare yourselves everyone on the left wing, the spending should trickle down, or perhaps more accurately, dribble down like water from a tiny distant faucet. And that should stimulate the economy. Former Federal Reserve Chairman Ben Bernanke, during the post-2008 financial crisis era, openly discussed how rising asset prices were an explicit goal of monetary policy. The logic was, in essence, we can't get the poor to spend money that they don't have, so let's pump up the rich and see if they can buy a second jet ski. By keeping rates at 0% and injecting liquidity, they created a massive asset boom that benefited the 10% of households who own over 80% of the US stocks, or at the time, because now that number is closer to 90%. Now this policy, by proxy, is a kind of a macroeconomic reverse Robin Hooding. They are actively trying to make the rich richer, hoping that the secondary effect of them purchasing bespoke alpaca wool sweaters will somehow keep the economy humming. However, one also giant reason why the government is doing this is more of a global motive, and that is trade. Policymakers always love a dollar that is just a little bit weaker, because while everyone loves to stand on a podium and declare the dollar is the strongest currency in the universe, if the dollar is too strong, US-made goods become very expensive abroad. A deliberate, controlled erosion of currency, or letting the dollar weaken against, let's say, the Chinese yuan or the euro, is a non-tariff trade incentive. If the dollar is weaker, that Ford truck rolling off the assembly line suddenly costs less for a buyer in Germany, boosting US exports and theoretically protecting domestic manufacturing jobs. It's a key part of the modern trade war playbook that's going on right now. It's a passive-aggressive way of saying we'd love to trade, but we're just going to make our money slightly less valuable until you agree. Now, for decades, the US has benefited from exorbitant privilege of the world needing US dollars to trade for oil and to keep their central bank reserves. This privilege gives the US a unique ability to run massive trade deficits without suffering the usual consequences of national bankruptcy. But to maintain the illusion of health while running these deficits and increasing the debt, policymakers are forced to embrace this dollar erosion. However, there's one part that I touched on that I really want to drill down to everyone here. Is that for most of this video, I talk about the feds, the government, the people at the top, the ones that own the assets. And those are what everyone focuses on, especially on some big networks, especially big financial channels and big financial TV shows. Essentially, if the macro numbers look good and the stock market goes up, that's supposed to be good for the country. And that's where I want to stress that word supposed to be good. But what we're witnessing right now is essentially the annihilation of the middle class. Between 1989 and 2019, the median net worth of the top 1% increased by over 300% in real terms, while the median net worth of the middle class grew by a measly 50%. Since the pandemic, that trend accelerated into a full-blown sprint, with the net worth of the wealthiest 1% soaring by over $15 trillion in 2 years. Meanwhile, the bottom 50% of Americans, over 165 million people, collectively own roughly the same amount of wealth as the 3 richest people in this country. Think about that for a second. The top 3 richest people in America have the same wealth as 165 million people at the bottom of the country. So this is the great generational trap. Young people are now entering the job market with wages that have been structurally suppressed by globalization, while simultaneously being asked to buy assets like housing that they have been structurally inflated by the central bank policy. Essentially, you're being asked to play a game where the required starting fee has doubled, but your income hasn't. The dollar you earned in 1971 when Nixon severed the last link to gold and essentially gave the government a blank check, well, that has had its purchasing power eroded by over 85% since 1971. Imagine a cup of coffee that loses 85% of its caffeine content, and every financial expert is just shrugging and saying, well, try drinking less coffee. The result of these federal policies has essentially split and severed the country, and it's all manufactured. Homeowners who are now as old as they've ever been, where the age of the first-time homebuyer is, again, highest it's ever been in this country, they are accidental beneficiaries of this grand monetary experiment. Non-homeowners and first-time homebuyers are left to stare through a window at what they can no longer afford, forced to finance the inflated asset prices of the people that they work for. So it's created a deeply toxic zero-sum economic reality where the only way to get ahead is to stop relying on wages and start relying on asset speculation, which requires the very capital that the system is actively melting away. So in short, the policy of deliberate dollar erosion has been a masterpiece of short-term political thinking. You know, it's something that I think about a lot, about how every single administration, pretty much in the entire Western world, has had almost this exact same monetary policy. It doesn't just apply to the United States. Every single country is willing to take on more debt, keep spending more money that they don't have at the expense of eroding their own currency and at the expense of the entire middle class. And in my opinion, this is something that cannot continue. Or else we will go back to the good old days of a feudal society that lacks rights, that lacks liberty, and lacks a good quality life. Now, if you liked this video, please check out my documentaries playlist where I have a ton of other videos just like this on there. So make sure to click on that, and I'll see you guys in my next video in just a few seconds.